Have you ever entered on a perfect pullback only to watch price take your stop and then move exactly where you expected? That might not have been bad luck. You may have been the liquidity the market needed. And then that's where inducement comes in. What is inducement? Inducement is liquidity that attracts traders into a position before price continues in the current direction. Let's explain what I mean. We are going to look at two market conditions: when the market is trending upward and when the market is trending downward. And I will use two illustrations. The first one will be using a diagram, and the second one will be using a chart. If we have an uptrend making higher high, higher low, higher high, higher low, and higher high. From this structure, you can see that there's a break of structure here, and there's a pullback, and there's another break of structure. How do we know which one is inducement? You don't predict inducement. You follow what the market structure is doing to spot out inducement. So this is pullback and this other one is pullback. So if price pulls back again and takes out this pullback here, this becomes our inducement. And most of the time, this is the logic behind the inducement. Market is already making higher high, higher low, higher high, higher low. And you can see buyers are buying from this point. And when it got to this other point, when another break of structure is formed here, some buyers will expect price to pull back to this point and trade higher again. But what smart money does is to wait for this liquidity, for this buyer that will buy here to be trapped, and the market will continue. And when price pulls back, let's look at it together. There are two types of traders that will be trapped here. Traders that will see this other pullback that will take this low as change of market direction, and traders that would want to trade continuation from this point. So if we have price here pull back and take out this, we place the sell order here. Let me mark it. Some traders will place their sell order here, and traders that place buy order on this POI, their stop will be taken out. And once the stop is taken out, price will move down to this POI, and after mitigating this POI, price will then move up to create another higher high. So this point becomes our inducement. So we can then label here as the inducement. So logically, is two types of traders that will be trapped here. The people that trade continuation using break of structure here will be trapped and their stop will be taken out. And people that will want to trade reversal and assume this as a change of market structure, change of character, will also be trapped here and their stops will be taken out. So this is inducement. We can have another example. If you have multiple pullbacks, like markets making higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, sorry. So if you have one, two, three pullbacks, which one is supposed to be our inducement? As you can see, none of this is automatically the inducement because price can trade through all the pullbacks. But this is what happens. once price takes out the recent pullback and trace to a nearby POI and shows a reversal sign, can then enter and target the next high. So this becomes inducement. Most of the times, all these lows are liquidity created. So this is also our inducements when it traces and takes out this. So this becomes our inducement. This is for uptrend markets. Then the next one is downtrend. If you have lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and markets comes to take the lower high before mitigating this and also trace down. This becomes our inducement. So we can mark this as our inducement, and it's still the same logic behind the other one. So when we get to charts, you will understand better. So let's continue. Can inducement happen before break of structure? Yes, inducements can happen before break of structure. Like in this situation, you can have market moving higher high, higher low, then it will create pullback without causing break of structure, and it pulls back again before having break of structure here. In this case, this can be our inducement. Remember, there's no break of structure here. Here is where the break of structure is confirmed. So in this case, the inducement has occurred before break of structure. This is just pullback without inducement, so without break of structure. So here can also be our inducement, even though it occurred before break of structure. So inducements can happen before and after break of structure. Let's go to chart so that you get the full gist. So we have our structure here, where we have higher high, higher low for uptrend. As you can see, market structure is confirmed here. Here is our higher high and here is our higher low. Market is making series of higher high, higher low, higher high, higher low, and there's a break of structure. And this is a typical example of the last example I gave, where inducements can occur before break of structure. Here is pullback. This pullback now was taken out by this high here. So this becomes our inducement. As you can see, after this inducement was created, price pulled back to take out the inducement and mitigated this POI, which is the other block here, and continued trading up. So this is inducement. And we have another break of structure here and pullback. This pullback was also taken out by this other high here. Once this high is taken out, the pullback here is confirmed. And as you can see, after this high was taken out, market pulled back to take out the inducement and mitigated this other block and continued trading higher. The same thing, and there's a break of structure here. So after break of structure here, there's another inducement here along this line. So you can have your you can mark this as your higher high once there is a break of structure, and this one is higher low. This is our inducement. There is a break of structure here, and here is another inducement. This inducement was taken out and the POI was mitigated and market continued higher. So this is for uptrend. Let me look for downtrend example. As you can see, this is lower high and lower low, lower high and lower low. Here is the inducement that was created. After this inducement was created, price put back to take out the inducement and mitigated the POI here. So this becomes our inducement, IDM in short form. So this becomes our inducement. So this example is for downtrend. trend. This is how to spot and mark out inducement. So inducement is one of the strategies in smart money concepts. So you have to pay attention to it very well because you are going to use it uh, in market structure and your smart money concept as a whole, even ICT trading. When you look at a chart, don't just see candles moving up and down. Think about the traders behind those candles. Someone buys the breakout, someone buys the pullback, someone places a stop below the obvious low, someone else is waiting for price to reach liquidity above a previous high. And suddenly, that ordinary looking pullback isn't so ordinary anymore. That's the real idea behind the inducement. It's not simply a candle, it's not simply the last pullback, and it's not automatically the first pullback after break of structure. It's about the liquidity the market creates, attracts, and may eventually seek before making a significant move. So see you in the next video.